Hi, and welcome to the Unio market update for the month of May, where we look back at the previous month's experience within markets and also have an outlook for the month ahead. Today, I'm joined by my colleague, Alex Kinsella. Hi, Alex, how are you?
Hi, Gerald. Good, thanks.
So let's jump straight in, Alex. Equity markets continue to remain resilient over the course of the year to date and are up over 8% in US dollar terms. Do you want to maybe take us through this?
Sure, absolutely. So what we're looking at here is a chart with two sectors, the IT sector and the financial sector, being mapped against the world index over the year to date and expressed in dollar terms. And what we can see is that the markets in general have been fairly strong. We've seen a robust rebound from the end of last year. And there has been quite a disparity between the sectors. So the IT sector, so growthy stocks are performing, whereas the financial sector, with all of the pressures that it's felt midway through this period or during March, can be seen very, very clearly. In general, economic activity has been fairly resilient despite all of the different headwinds we've seen. And what that is doing is effectively pushing down the recessionary risk further down the road, and that's allowing the market to move forwards in this fashion. The currency is worth just pointing out. So this is in dollar terms. So from a euro investor's perspective, with the dollar weakening versus the euro, that means that we would have slightly impaired performance on that basis. That may continue a little bit due to the interest rate cycle, Europe being behind that of the US, still on that upward trajectory, whereas the US may be pausing. And the impact on that will be seen through the bond yield curve. And maybe if I just jump forward a slide, you can maybe, Gerald, bring us through this slide.
Sure, thanks, Alex. What we've represented here is the US yield curve, or the cost of US borrowing at different maturities, all the way from short term right out to 20, 30 years. And under, I suppose, a traditional view, you'd expect an upward sloping yield curve to reward the investor for a longer term investment. That essentially, to get in simple terms, get a higher yield for the longer you invest. But what we can see from the yield curve that we've charted here, we've charted 2 points. We've looked at the yield curve in green at 31st December and how it's evolved actually to currently in orange. And you can see that the shape of the yield curve is anything but upward sloping. Now, it takes into consideration at the shorter end of the curve on the left that there is, I suppose, an assumption from the market that there will be somewhat more of a rate hike coming through in the short term by the US Federal Reserve. But ultimately, going into, I suppose, 12-month outlook and beyond, the market is pricing in a significant rate cut coming through on US interest rates. And this can be for a number of factors, looking at where prevailing rates are. They're too high, but I suppose we have to balance that with the fact that the US central bank in this instance is trying fairly significantly to dampen down not just headline but core inflation as well within the economy, all the time being cognizant of the impact from an unemployment and an economic growth perspective. But I suppose looking beyond those factors, Alex, for the month ahead, there's quite a number of aspects still that are going to pose a challenge.
Yeah, there certainly are, Ger. And actually, that balancing act that you're alluding to there, that the central bank has been playing over the last while, those significant increases in interest rates, that has obviously caused a major issue in the banking sector. And this is an area we think is going to be very prevalent over the next month or two. So will there be further banking consolidation? And it's likely that there will in short. The implications for the fallout of the Silicon Valley Bank and other regional banks in the US, and the flight of deposits towards larger banks or towards treasuries, that is having a significant impact. And even yesterday we saw more banks coming under really significant pressure. So that's a theme which will continue, and it will prod the Fed towards changing its interest rate policy, and obviously the knock-on impacts of that. One of the other areas that are very interesting is the US debt ceiling countdown. So that has begun in earnest. The the debt ceiling is likely to hit some way through the middle of the year. There's kind of debate around which month, July or August, maybe even a little bit sooner than that. But certainly what we expect to see is dislocation in markets as we approach that, and rising levels of volatility in markets as we approach that. So some of the other items, such as central banks and geopolitics, Gerald, maybe you want to bring us through those, but they're certainly items that we need to consider.
So from a central bank perspective, we've gone through, I suppose, the impact from a Federal Reserve, but I suppose we really need to be cognizant of, we've reached a more or less of crossroads now where the US Federal Reserve and the ECB potentially are going to diverging paths, with the Federal Reserve, I suppose plateauing or stalling on further rate increases, whereas the ECB is more or less committed, and ultimately standing aside from the shadows of, I suppose, that path that the US Federal Reserve had taken. And I suppose the impact of how that plays out will certainly be of interest. And you spoke about the euro dollar position, that will have a key influence there as well, or a key driver. From a geopolitics perspective, we think about US-China relations and the strains that are coming through there. They continue despite positive GDP numbers in China over April. I suppose the equity market underperformed, driven in large part by this. I suppose that risk coming through from a political perspective. We also have to be cognizant of the effects of deglobalization and underlying, I suppose, companies' efforts to redraw the lines of their supply chains, and as they do that, what it ultimately means then from an inflationary contribution perspective as well, and can they source, I suppose, their input materials at the same level or input costs as they had previously. From an inflation perspective, headline inflation is reducing whilst still somewhat elevated, but we're looking at core inflation across both the Eurozone and the US remaining elevated at 5.6%. It is very sticky, and the central banks ultimately have a challenge on their hands there to try and bring that down that further. But I suppose pleasingly, from a headline perspective, lower energy costs are helping to bring down that headline inflation number. Still, there's quite a bit there for the month ahead, for month ahead of May, and plenty of us for us to chat about next month, Alex.
Yeah, there certainly is, Gerald. And thank you very much for that. There's a lot to look forward to. It's going to be an interesting month, and we look forward to touching base with everybody at the end of it, just to give you an update on how markets have progressed and how the macro aspects have moved. Thanks very much for your time.
Thanks very much, Alex. See you now. Bye-bye.